Well, it looks like Powell is starting to pivot for the next Fed meeting in September. So, what does that look like, Dustin?
Yeah, Jay, the Fed has had really tight monetary policy for the last 3 years. So as they start this easing process, everything from savings, CD rates to mortgages and the equity market are going to have a little bit of a change coming up. So stay tuned while we dig into it.
Hi, welcome to T Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And like how we mentioned in the intro to this video, we're going to be talking about Powell's most recent comments as they're leading up to the next Fed meeting in September and the potentials for if they do a rate cut here and what that's going to mean for everything when it comes to mortgages, businesses, stocks, you name it.
Yeah, Jay. So as I mentioned on the intro, monetary policy has been very tight for the last 3 years. We all remember 2022, and prior to that, coming out of COVID, we had rates at zero because they were trying to help out the economy, right? Well, because of factors like injecting so much money into the system because of COVID, we had inflation go extremely high, the highest we've really seen it, certainly in our lifetime. And that caused the Fed to counteract that by raising rates. So 2022, we saw a massive tightening cycle by the Fed. Well, they're finally getting around to potentially lowering rates. And this has really been on the forefront here. We've been thinking that the Fed was going to start lowering rates a little bit more aggressively here for some time. But just last week, Powell really at Jackson Hole really, I would say, committed to starting that cutting cycle. So that's going to have a lot of impact, throughout different investments and for people's money.
Yeah, and the last rate cut we had, I believe, was in December of last year, and it
He
seems
teased
like
us just a little bit. It was like
just
one rate cut.
right, exactly, and it seems like that the Fed was just going to remain tight with that and not make any changes for the most part. And I know the Trump administration has really been pressuring the Fed to just continue to lower rates. I
Right.
think with Powell, one of the comments he made at Jackson Hole was, well, if I step back a bit, one of the biggest worries they had was with all these new tariffs coming into place, how is that going to look like from for an inflation perspective? And Powell's comments it looks like it's signaling that that was just kind of a one-time, called it a tax increase, and it's not an ongoing thing. So it looks like that they're looking past that now and really looking at things like, well, the biggest one is the current labor market and how
Right.
that's not going as what they're expecting it. It's actually cooling, to use one of their terms.
Well, remember, so the Fed has two mandates. It's, keep stable prices and full employment. Prices, let's just say inflation has come down significantly since 2022, and we'll show some data on that. It's come down a lot, and now we have the labor market cooling a little bit, like you say. So the Fed has kind of pivoted to focusing on the labor market and not wanting that to get too out of control. So as far as jobless claims going up. So I think there's a lot of thought out there that the Fed might be a little late to this party. I mean, it seems like the Fed is always late, whether it be they were slow to raise rates because they said inflation was transitory after COVID, and now we could argue that they are probably a full 100 basis points or so too tight. So they're kind of catching up here. I hope it's not too late, but I really personally think that they need to get to a more normalized rate here given the data. So maybe we'll jump over to at least the inflation side of things. This is a really interesting chart from Wisdom Tree. So you're going to see two lines here, and the gray line is basically the inflation rate that the Fed is looking at, and it's based upon the BLS data, and the blue line is real-time data, let's just say. So it's no surprise that government data has a huge lag to it. It's kind of antiquated on how they calculate it.
And real quick, how would you describe the real-time data?
Yeah, so real-time
versus the BLS's data.
So the BLS data, in particular, the shelter data that they're looking at, has a very, I'll just say that has a very antiquated way that the BLS collects the data. It's like literally phone calls and, surveys, where the blue line is Wisdom Tree's real-time shelter data, and they use things like Zillow, apartment.com type of data to see what are actual home prices doing, what are real-time rentals doing. And of course that makes sense, right?
Right.
That is like really what is going on today. They're not looking backwards. They're not making phone calls to people trying to figure out what home prices or rentals should be. So you see a big discrepancy here. And I think Wisdom Tree nailed it when they called the inflation going up way quicker than the BLS did. And this is headline inflation. And they called the peak of inflation at 12.5%, where the Fed called it, BLS called it, 8.5. Now to look to where we are now. So this is 2022. Fed raised rates dramatically during this year in 2022. And it's come down to, the Fed is kind of looking at around just under 3%, where real time, when you use real-time shelter, it's just under 2%. And again, the Fed is looking at a target inflation rate. They want to be around 2%. So if we look at real-time data, we're there, and they should be cutting at least to support the labor market. And again, this is a little out of my studies here, but people that I trust in this this industry and in this kind of macro view of things, they should be about 100 basis points lower than where they're at now. So this is headline. We can scroll down here. This goes back to just shelter inflation. I think this tells the story, Jay, to your original point, as far as real-time data versus what the BLS looks at. And you can see real-time data showed huge spike in the housing metrics way before the BLS ever did. And you can see even the discrepancy now. I think that is just the big difference in the lag data. And that's kind of coming back to why there's that difference here now.
Yeah.
So I thought that was pretty interesting. So, with the Fed looking like they're going to be pivoting and starting a rate cutting cycle. Now, I personally think it's going to be a pretty gradual cutting cycle, 25 basis points, maybe a meeting until they get, maybe a percent lower or so. We'll see. So long as nothing implodes, I think that's reasonable. But now we can kind of talk about what are some of the implications from rates going from where they're currently at, about 4.5%. Let's say they go to 3.5% over the next year or so. Kind of what implications will that have?
Yeah, the one that comes to mind is going to be CDs or savings rates. A lot of people, especially that I've seen during tax time, they've just put their extra cash into these 12-month CDs because they were paying about 4.5%, versus maybe a couple years ago they were paying barely 2%. And I think if those rates do start to come down, if it is a percent lower eventually, you're going to see that same effect on the CD rates, and it might actually be less. So instead of 4.5% or 4.3%, that's where the Fed funds rate is at right now, it might be at just shy of 3% or maybe even 2.9%. And so that's going to be a huge difference. Now, that's still better than just having it sitting in a checking account, making 0.001, whatever the case is, but still, you're not getting that same savings rate from 2 years ago. I think that's going to be.
People were really excited over the last couple of years because we were so used to getting nothing in really in CDs, nothing in savings accounts, nothing in money market accounts. So when it went to, I remember seeing like 5.3%.
Yeah.
That's kind of where I remember it peaking out at. People were really excited. So that's definitely going down. And I've already seen CD rate renewals going down, I think, in anticipation of this. So that's definitely one area that's going to see a reduction. I don't think it's going to zero like it was prior, but
No.
it's definitely going to be lower than 4.5, kind of where that's at now. I could definitely see 3 to 3.5%. And ultimately, if that's your emergency money, if that's just some extra savings, it's a lot better than zero.
Yeah, and I think a side product of that too is a lot of these CDs that are maturing and people not wanting to renew it, they might want to put it back into the market. So I think we're going to see a huge amount of capital slowly get back into the market. Maybe that's where it was initially, and people cashed out because of the craziness of COVID and whatnot. I think we're going to see a huge shift of capital back into the market because of that.
Well, it was really easy for people to say the market's volatile. Let me take money out of the market and I'll park it and make 5%. And you could feel good about that.
Yeah.
When that starts to go down, I think people will look elsewhere. And, some of that I'm sure will go to equities. Some of that might go to some other fixed income products that maybe will retain their yield a little bit longer. So I definitely think that is going to be happening. To the equity side, there are areas in the market that are more interest rate sensitive that will get a little bit of a boost. We've been seeing currently, small cap type of equity, so small companies, which, let's be honest, have had a rough year and have had a harder time with higher interest rates because small companies don't have access to capital like Google does or Apple does, right? They don't need the capital markets in the same way. And they're more risky, so their rates are way higher when they're borrowing money. So, and their variable rate, there's, what is it, $20 trillion of loans that are pegged to the Fed funds rate. So if that comes down a little bit, you have these variable type of products, variable loan products that will also come down a little bit, which should help these companies spur, some capex, maybe just some growth within their business. So we've been seeing small cap equities front running this a little bit. They've been doing well. Just more, dividend type of plays, value plays have been doing better. We've seen some of that rotation from out of just mega cap tech to some other areas of the market, because those areas are a little bit they're a little bit underloved, so you're seeing that rotation and they might get a boost here from some lower rates, which I think is really positive.
Yeah, I think another one too, this is on a lot of people's minds, especially if they bought homes from 2022 onwards, would be a potential rate cut within the mortgage rates.
Yeah.
So I know some economists are saying if we do get a % cut by the end of the year, just within the next couple meetings, we could potentially see a full % reduction within just mortgage rates in general by mid next year.
Yeah, so I was listening to some commentary by some researchers, and they were explaining basically that right now is the biggest spread between mortgage rates and, let's just say, the 10-year treasury, because prepayment risk on mortgages that risk is very high right now, because we know that mortgage rates aren't really going to be going up, let's just say, over the next couple of years. So the mortgage companies are kind of really cashing in right now and getting the money while they can. And just naturally, if Fed funds rates come down, we see, maybe the 10-year come down a little bit, we should see that % or so reduction in mortgage rates, which I think will really help, obviously, the mortgage industry, the housing industry. You've been seeing housing stocks do very well in anticipation of that happening too.
Yeah.
It's really obviously hard for people to buy houses right now, just prices have remained sticky because inventory is not there. New construction doesn't keep up with the demand. So if we can get mortgage rates down a little bit, hopefully that will help out the affordability of them, and will spur some of that refinancing. People actually, willing to maybe move, because obviously a lot of people don't want to lose their very low mortgage either. So I think there's a lot of positives to come from the housing market over the next 1 to 2 years if we can start to get that Fed funds rate down and get the 10-year down just a little bit. I think we'll start to move in that direction.
Yeah, we all hope for that.
Yeah, I know, myself included. So
yeah, me too. Yeah.
So, I think there's a lot that's going to be taking place, really over the next few Fed meetings, really, because they haven't committed, right? But they have finally pivoted to say that they're open to it, and they think that that's the direction. Now, I feel like we've been kind of they've teased this before. I do think they're more serious now at this point, but we don't have the official cut yet, so time will tell.
Yeah.
But so we'll see kind of how this all plays out. But I think we'll continue to update with videos as this situation kind of changes here. But we hope that you enjoyed this current video. If you did, please like, subscribe, and we'll see you in the next one. Take care.